As an investor, what is the best use for tokenmetrics.com? Okay, so as an investor, I'm going to assume you mean as a value investor. So we've done videos before in the past in terms of how to use Tokenmetrics as a day trader or swing trader. Let's now do a video on how to use Tokenmetrics as a value investor. So hypothetically, obviously this is just me sharing my experience or my thought process, not financial advice at all. But let's say I have $10,000 and I want to invest and build a crypto portfolio. I don't have a portfolio at all. What would I do? Well, I would make sure come here on Value Investor because I have a long-term time horizon, meaning that I want to invest for long-term capital gains here in the US, meaning that I have to hold for more than 12 months. I don't want to pay short-term capital gains taxes. So Value Investor ideally is typically somebody who has an investment horizon of anywhere minimum 1 year, but I would say between 3 and 10 years. So you're not looking for a quick flip. You're not looking to speculate. You're not investing any house money. This is disposable money that you are willing to lose. If this money goes to zero, you're fine with that. How do you define money that you're willing to lose? I would say this is probably 1% of your net worth, right? Something like that. So if you're making, so if somebody is investing $10,000, I mean, that person has a lot of money, right? That person probably has $1 million. But okay, maybe it's not that strict, right? I would say, but at best case, don't put in more than 10% of your net worth into investing, right? Let's say you make 100 grand a year, you take 10% of that each year and you buy crypto, right? Okay, that's kind of a good example. So first thing first, at minimum, I believe to have a fully diversified portfolio, in my opinion, you have to have 10 cryptocurrencies. Now, some people have more, some people have less, but I think you have to have minimum 10 cryptocurrencies just to fully diversify, weigh the risk. One book I can definitely recommend is The Intelligent Investor by Benjamin Graham. And that book basically said to really have a diversified portfolio, you should have between 10 to 30 stocks. Anything more than 30, you're basically just investing in an index fund. So if you're trying to really target what you're investing in, I would say 10 to 30 applied to crypto makes sense. If you have less than 10, you aren't really diversified. I mean, obviously, maybe there are other ways to diversify through hedging and what have you, but I would say for crypto, minimum 10. Actually, I would probably go and say 11 if we add stablecoins, right? So let's say we take our portfolio of $10,000 and we break it up into 11 cryptocurrencies. So why 11 as opposed to 10? Well, I feel like part of your portfolio should always be in liquid cash, but in this case, we're in crypto. So I would say stablecoin, so that you can take advantage of dips to buy more. So that's my stablecoin of choice is DAI. DAI is a decentralized stablecoin. Right now, it's in 54th market cap. I mean, rank versus market cap. But this is, when it comes to stablecoin, I wouldn't really care much about the grids that much. You could also use Tether USDT, but in my opinion, DAI is a better stablecoin. So how does that break up? That breaks up into owning roughly 9% of 11, right? 9 times 11, 99 point something percent, right? So let's say 9%. So 9%, that's basically $900 of your 10,000 into DAI. And then you take that DAI and you do stablecoin lending on platforms like Celsius. One site I use is defirate.com. So go over here. If we go to lending rates, so for DAI, this shows you different platforms that are lending. So you can get 2.4% on CoinList, 2.96 on Nuo, Aave is 1.76%, what have you. But hey, maybe you use USDC, which is Coinbase, right? Maybe that actually makes more sense because they're paying 13% on Nuo, which is very, very good. Let me see if there are any other stablecoins. Yeah, so actually maybe scratch that. Maybe we put that in. Maybe, yeah, I would say maybe it's split up. Maybe have more than 11, sorry. Maybe have some in DAI, some in USDC. But anyway, the entire point is you want to have 9% in stablecoins. But don't put it all on one platform. Spread the risk because, as you know, it's crypto. Platforms do crash, whether they DeFi, like DAO and Maker had the glitch a while back, where it crashed, I think 30 or 40% in a day. One of the platform I do like is Celsius Network. So for stablecoin lending, this is a platform I like. I don't really use it much myself, but it's one I definitely do trust. They do have insurance. So if we go here for stablecoin lending, Gemini Dollar is paying out 8.6%, basically, almost 7. True USD is the same. DAI, actually, I'd probably use this for DAI then. DAI is almost over 8% annually on your money. So think of this as basically a saving account. So actually, yeah, I'll probably use this, probably put some, either one of these stablecoins, even Tether, on Celsius. Not sure why Celsius is not here. Okay, but yeah, I would use Celsius, and then I'd also maybe put some here in Newell, right? So maybe divide up that pie into 4. So 900 divided by 4, and spread the risk across different platforms. Okay, but now back to the crypto portfolio. What would I do? Okay, first of all, I'd make sure I have an account on Token Metrics, obviously. Then I'll go through here, Value Investor, using purely the overall grade, not fundamentals, technology, or TA, because all this creates the overall grade. I'll go through here, and basically I'll have an evenly balanced portfolio, meaning that I'll put 9% of the remaining 10 different cryptocurrencies into each crypto. So $900 into Bitcoin, Ethereum, Binance, Cosmos, Blockstack, Zcash, Dash, Synthetics, Zcoin, and Neo. Those 10, evenly balanced. I know in the crypto world, people say this is very aggressive portfolio, but hey, I mean, that go big or go home, right? But it's not for everybody. Once again, this is money we're willing to lose, right? We're not spending rent money or house money or grocery money. This is money that if it goes to zero, we're fine with it, right? So that's why I definitely advise, obviously not financial advice, but I still recommend that only invest what you're willing to lose, because people always forget that. Because if it goes to zero and you cry about it, you put in more than you are willing to lose. Okay, now going back to this, so that gives us 10 cryptocurrencies plus a stablecoin, which is 11. That's the portfolio. Next thing is to come up with a time to rebalance the portfolio. So because this is a value investor or long-term portfolio, the strategy would basically be at minimum 1 year, but maybe even longer, right? But let's stick to 1 year. So today is, we're in May. So meaning that I would buy those 11 cryptocurrencies, lock them up, right? Actually, so since we have some cryptocurrencies here that are going to be locked up, one good idea and tip is to also lend these out as well. So if you have some Bitcoin and Ethereum, if you go to Celsius here as well, they pay you, Bitcoin, they pay you 4% annually for lending your Bitcoin out. So obviously I would not lend out everything, because what if it crashes? Obviously they have insurance, but still, you want to manage risk. I'll probably maybe lend out maybe like 20% of my Bitcoin on there as a hedge, something like that. Ethereum is 3.8%, because we had some Ethereum as well. I think that's all that we had in the portfolio. If you're curious about Celsius, feel free to use our affiliate link that does support the channel. Just go to tokenmetrics.com/Celsius, I believe is the link. But let's go back here to Bitcoin. Block fee gives 6% annual interest. Then for Ethereum, Bitfinex, but that's an exchange, could crash. Block fee gives 4.5%. Block fee, I believe, does have a minimum requirement, so please research that. Then did we have any other currencies here on our list? But basically the entire premise is, since all this is long-term investing and it's going to be locked up for a while, whatever you can get some interest on, you want to get interest on, because that's free money. And then if any of the cryptocurrencies you own also have staking, it's also a good idea to stake. So for example, Cosmos has staking, I believe. Binance does staking on their exchange, I believe. So one other site I like is stakingrewards.com. Let me pull that one up. So whatever you have in your portfolio, you want to be earning some passive extra income on. So Cosmos, right? Cosmos is over 8% annual reward on Cosmos, which is pretty good, right? So meaning that our $900 staked annually for Cosmos will give us $72 extra, right? So I mean, free money is free money, because if you're going to be locking up money, you want to be getting paid for it. Then Synthetics, right? Synthetics was in our top 10, and if we're going to be holding that for longer than 1 year, oh man, holy cow, is this legit? Hold up, so Synthetics is giving out 52%. Okay, so I'm not if this is legit, you definitely want to be staking. I mean, I'm not sure. I'd have to double check this. Don't quote me on this. Now, I know the site is legit, but if this number, I'm not sure why it's this high. Okay, so yeah, so if you stake it, you're getting 52% annually. Oh man, I may have to sign up for this. But I mean, this is how you multiply your money, right? So imagine, so obviously I'm just speculating with these numbers here, but if we have $900 and we're getting 0.52, we're getting $468 by staking Synthetics. Okay, you know what? I think I could probably understand why it's a very high rate, because I believe Synthetics does have trading. So maybe that includes trading fees that you get for staking and providing liquidity. Maybe that could be why. But man, I mean, we're going to have to do some more research into Synthetics. But I mean, that's kind of the idea, right? So as a value investor, that actually makes more sense. I mean, trading is nice, but value investing is my preference. Zcoin and Neo. Let me see if we have any of those here on stakingrewards.com. Zcoin is 13%. So not bad, not bad. So as you can see, the entire idea is you build your portfolio and you stake whatever coins you can to earn passive money. Basically, it's kind of like dividends. And then what you cannot stake, you lend it out and earn money on that as well. So in an ideal world, as a value investor, everything in your portfolio that you're holding on for the long term should also be paying you to hold it, right? Not just in the long-term growth potential as an investor, but also it's kind of like, it's basically like bonds. It's paying you, right? So that's what I would do. That's why we think Token Metrics is very powerful. But if you also add in staking and lending, oh man, you could be printing money, literally, right? Whether it's Synthetics, Zcoin, obviously it is crypto. There are lots of risk involved. I mean, all these coins could go to zero, but I mean, that's why we think going through and having a value-based investing approach where we go through and we look at the fundamentals, the technology, and the TA, and then going back to what I talked about, rebalancing, right? So let's say you have a portfolio, right? And the way it's broken down across those 11 coins is 9% across each. But let's say one of the coins goes on a tear and does very, very well. Let's say Blockstack becomes 15% of your portfolio, and let's say Zcash becomes 5% of your portfolio. Basically, Zcash went down 4% by a lot, and then Blockstack went up because let's say it has a low market cap rank and market cap, and it's going to go up. What do you do after 1 year? Because 1 year is a time period you have picked to rebalance your portfolio. This is what I would do, right? This is basically modern portfolio theory if you want to research into this. So 1 year later, basically next May, I would look at my portfolio and I would rebalance the weights. So if there's any cryptocurrency that is no longer in the top 10, I would sell that, right? Either at a loss or taking profits, whatever, right? If it's still in profit, you take those profits and sell everything because it's no longer in the top 10. So meaning that for the next 1 year, it's not really optimistic on it at this point in time. And then if there's a new cryptocurrency that wasn't on the list, but is now in the top 10, I would buy that. So basically, doing it this way forces you to buy low, sell high, because humans and emotions prevent them from buying low and they prevent them from buying low to sell high. What they typically do is they buy high and sell low. So automating it in this manner helps you lock in profits and also get away from losing money. Now let's say Blockstack is still in the top 10, but it's now 15%. Your weights are meant to be 9% for each cryptocurrency in your portfolio. What do? You would take those 6% weight of Blockstack and sell that to cash or fiat or whatever. Well, actually, probably more like a stablecoin or Bitcoin or Ether, to bring that back down the weights. So it's because you want it to be balanced. So it forces you to take profits on Blockstack. It forces you to take profits on your winners. And then this part here is the vital part. Then you take those profits and you buy the dip on your losers. If those losers are still in the top 10, that means it's still optimistic on their long-term potential and outlook, and it forces you to buy the dip, because your emotions might tell you this is a falling knife, I don't want to buy, and you don't buy and you miss out. But doing it this way forces you to buy the dip on good projects. So if something is still a good project, if it's still in the top 10, so the example was Zcash, if Zcash is still in the top 10 and it's dipped all the way down to 5% of your portfolio, you have to bring it back up to 9%. So you have to buy the dip. And that right there, my friends, is time and true tested, one of the best ways to be a value investor. This is called modern portfolio theory. Research this. There are lots of books out there. Now, one of the books I recommend is called The Intelligent Asset Allocator by William Bernstein, I believe is his name. A great book, quick read. I think I probably went through the book in about 4 or 5 hours. There's an audiobook as well, so very, very good book. But that, my friends, ladies and gentlemen, is how you become a value investor, and you do it the right way. I know I haven't really kind of covered it end to end, but whoever asked the question, thank you for that. Because really, yes, we know that there are lots of traders out there, but for value investors and hodlers, this is how you do it. I haven't really seen many people kind of cover it like this, but let me know what you think down in the comments below. Thank you.